The signal is perfect. On the 5-minute chart, the price action paints a textbook image of a bullish reversal. A sharp decline culminates in a flawless hammer candle, its long, lower wick signifying a violent rejection of lower prices. The subsequent candle is green, closing above the hammer's high, providing immediate confirmation. Volume, the supposed fuel of market conviction, explodes. It is the highest volume spike in over 47 candles, a clear footprint of institutional buying. To the trained eye, this is not just a signal, it is a foregone conclusion. Momentum oscillators confirm the narrative, showing clear bullish divergence as the price printed a lower low while the indicator printed a higher low. Every element of the trading textbook aligns in this single, crystalline moment. It screams, buy! Yet this trade has a statistically validated failure probability exceeding 95%. This signal is not an opportunity. It is a meticulously engineered trap. Welcome to the Trade Logic Lab. Today, we deconstruct one of the most pervasive and destructive cognitive biases in trading, the timeframe illusion. We will dissect how the market's true directional intent is encoded on a temporal plane most retail traders are conditioned to ignore, and how the most obvious intraday setups are frequently calculated traps within a larger, invisible structure. The hammer candle is not a reversal. It is bait. The anatomy of this illusion is predicated on a simple, exploitable truth of human perception. We assign significance to what is immediate and visible. The 5-minute chart presents a compelling, self-contained story. A clear villain, the downtrend. A hero, the bullish rejection. And a clear path to victory, the expected rally. The trader sees this pattern, feels the urgency, and acts upon a localized dataset, believing it to be the entire truth. This is a critical error in logic. The price action on this time frame is not an independent event. It is a subordinate clause in a much longer, more complex sentence. Its meaning is entirely dependent on a context that exists outside its own borders. The explosive volume, interpreted as buying pressure, is a misreading of the evidence. The bullish divergence is not a precursor to a rally. It is a symptom of a much larger market operation reaching its final, critical phase. To understand why this signal is a trap, we must first dissect the hidden architecture of the market's memory, an architecture encoded not in price, but in time itself. This is the 4-hour chart for the same instrument, viewed over the past 3 weeks. The seemingly dramatic downtrend on the 5-minute scale is now revealed for what it truly is: a minor pullback, a slight exhalation of price within a much larger, dominant structure. The flawless, bullish reversal did not occur at a random point in space. It materialized at the exact lower boundary of a massive, high timeframe supply zone, an area where a significant imbalance of institutional sell orders resides. The narrative collapses. The story told by the 5-minute chart was a fiction, designed to be read and acted upon by those who cannot see the broader landscape. That explosive volume was not aggressive buying. It was the sound of a vast wall of institutional sell orders, absorbing the frantic, hopeful buying of retail traders who saw a bottom. Every buy order, triggered by that perfect hammer, served as exit liquidity for a far larger entity preparing to drive the market significantly lower. This is not a random occurrence. It is a fundamental market mechanism. Large institutions cannot simply place a billion-dollar sell order without collapsing the price against their own position. They require a counterparty. They need a crowd of willing buyers to sell to. The 5-minute chart is the stage upon which the performance is held to attract that crowd. Algorithms can, and do, paint these seemingly perfect patterns in key locations to induce demand. They create a pocket of localized optimism, a bullish signal engineered to attract capital. The hammer candle, the volume spike, the divergence, they are the siren song, luring traders onto the rocks of a higher time frame reality. The market is a fractal environment, but not all fractals carry equal weight. The directional intent of a daily or 4-hour chart holds an exponentially greater specific gravity than the noise of a 1-minute or 5-minute chart. The latter often exists purely to facilitate the business of the former. The smaller time frame is where liquidity is harvested. The larger time frame is where direction is decided. But the institutions leave fingerprints. The very structure of this manufactured price action contains a statistical signature, a warning that is invisible to 99% of traders. To find it, we must look beyond the candles themselves and analyze the texture of the price delivery. The efficiency of the initial move down, followed by the grinding, overlapping nature of the reversal, tells a story of distribution, not accumulation. The trap is now set. The trader who followed the textbook has entered their long position. Their stop loss is placed neatly below the low of the hammer candle, just as the books dictate. They are now part of the liquidity pool. Their position, and thousands like it, represent the final piece of the puzzle. The algorithm has gathered its fuel. The buy-side liquidity is absorbed. The true directional order flow is now about to be unleashed. For the trader who took this signal, the screen is about to display not a profit, but a mathematical certainty, engineered on a temporal plane they were never meant to see. The illusion is complete, and the cascade is about to begin, but it doesn't. Not yet. And this, right here, is the masterstroke of the deception. It is the second, far more insidious layer of the trap. The immediate, catastrophic failure of the pattern would be a lesson. It would be clear, brutal, and educational. But the market is rarely that kind. A far more profitable strategy is to first validate the victim's flawed logic. What if the most dangerous lie the market tells you isn't that you are wrong, but that you are right? Just for a moment. The trader, who was just bracing for impact, now breathes a sigh of relief. The anxiety melts away, replaced by a surge of vindication. I knew it, they think. The hammer held. I was right to trust the signal. This is not an accident. This is psychological warfare. The algorithm's objective is not merely to trigger the stop losses sitting below the low. That is far too small a prize. The true objective is to coax the herd into adding to their position. To use that initial, engineered signal as a foundation upon which traders will build their own financial ruin. It allows the price to drift up just enough to turn fear into greed. Those who were hesitant now jump in. Those who were already in now add more size. It's working, they tell themselves. I should maximize this. The algorithm is listening. It doesn't have emotions, but it reads the order flow, which is the physical manifestation of human emotion. It senses the decrease in panicked selling. It senses the influx of new, hopeful buy orders. It measures the growing cluster of stop-loss orders, the fuel, and it waits. It is holding price in a state of suspended animation, a carefully constructed purgatory, allowing the trap to be baited with more and more capital. The upward price action is weak, overlapping, and struggles on low volume. All the classic signs of an artificial move. But the trader, high on confirmation bias, doesn't see this. They see what they want to see: a winning trade. And then, when the buy-side liquidity has reached an optimal threshold, when the last ounce of hope has been squeezed from the available data, the floor gives way. It is not a slow decline. It is a vertical, instantaneous repricing. It moves with a ferocity and efficiency that the fake reversal never had. It slices through the entry points, the added positions, and the neatly clustered stop losses in a single, merciless motion. The cascade is a chain reaction, as triggered stops become market sell orders, adding weight and velocity to the move down. The trader who felt relief, then greed, now feels nothing but shock. The small profit they saw moments ago is now a devastating loss. They were not just wrong, they were used. Their hope was the lubricant for the market's true mechanics. Their position was not an investment. It was the cost of business for a much larger entity. But who, or what, is truly capable of this level of temporal and psychological manipulation? To call it just an institution is too simple. We are not witnessing the actions of a human discretionary trader. This is the fingerprint of something else. A predator that lives inside the market's own nervous system. We call it the meta-algorithm. It is not owned by one firm, nor controlled by a single hand. It is the emergent consciousness of the market itself, a hyperlogical apex predator born from decades of high-frequency trading, machine learning, and quantitative analysis. It has no malice. It only has objectives. It learned our patterns, our textbooks, our emotional responses to fear and greed, and now it uses them as bait. The classic chart patterns taught in every book are no longer signals for us. They are hunting grounds for it. It doesn't trade against you. You are simply the environment in which it operates. To fight it is to lose. To try and outsmart it with the same flawed logic it feeds on is to become another casualty, another triggered stop loss providing fuel for its next move. So what do? We change the game entirely. We stop participating in the illusion. We begin to see the matrix. You must learn to read the code behind the price action, to identify the digital fingerprint of the algorithm, and recognize when a trap is being set. You must evolve from being the prey to being the observer, dissecting its behavior from a place of safety and understanding. This is not just a channel. This is our laboratory. We don't teach you how to follow the rules. We teach you how to see the rule maker. Subscribe to trade_logic_lab. Stop being the variable in their equation and start learning the logic.